Dr. Mullen, we were talking about capital loss, and I'd like to continue that conversation by having you to, first of all, define what is meant by capital loss and to give us some information in reference to that.
Okay, capital losses arise when taxpayers sell property, either real estate or stocks and bonds or whatever the case might be. Of course, capital gains arise in the same way. Now, the advantage of capital losses nowadays is that if you do sell property, that you sell it at a loss, then you can deduct the amount fully on your tax return, up to $3,000 a year. Whereas beforehand, if you had capital losses, in most cases, they were not fully deductible. You could only deduct 50 cents on the dollar. So for many people, if they have stocks and bonds or something, they might be wise to sell these things and go ahead and deduct the losses now, since they can deduct them in full rather than waiting until later on. Because, and you know, if you're going to sell something at the gain, it would be wise, tax-wise at least anyway, to put off selling it at a future time, because of course capital gains are also fully taxable. I'm just expressing my opinion here, but my personal opinion is that within a few years, capital gains are again going to be taxed at a much lower rate than they're currently being taxed, and so I would advise people to put them off anyway, just simply for that reason. For the same reason I said it'd probably be good to go ahead and take the losses now, because I think we'll probably go back to this system in the future where you only get to deduct half of it.
Well, from a practical point of view, Mr. Hoskins, as a person who's involved in practical matters dealing with income tax, do you see that as an advantage that you would advise your clients to take, or what? How do you see that?
I think Dr. Mullen is definitely on the right track there. There's been a tremendous amount of publicity regarding the capital gains tax and capital losses, and I would agree that I feel like a few years down the road that the capital gains, or the reduced amount of tax on capital gains, is going to reappear in the law. So it may be in fact wise to hold off, to hold those properties that are going to result in a gain, and deal with them a year or two down the road when I feel like that law is going to change.
Well, now, would that, Dr. Mullen, affect the tax rate? Let's say something about the tax rate. Would that increase your tax rate if you were to hold back that from filing for that gain or that loss? Would that affect your rate at all?
No, but I think what we are most concerned about is that tax rates currently are the lowest they have been now in my lifetime, I guess, ever since, you know, the Second World War, since the beginning of the Second World War. And quite frankly, no matter who is elected president, the tax rates are very likely to start edging on up in the future. And again, there's no big secret, because it's been openly said if a Democrat is elected president, which is entirely possible either in 88 or 92, they would favor increasing the tax rate. So you can look forward to whatever the circumstances is, that tax rates are very likely going to go up in the future, either in a year or two or in 5 or 6 years. Very good. I think you would agree with that, wouldn't you?
I would agree. What many people may not realize is that when the current administration first took office in 1981, the maximum tax rates could in fact go up to 70%. Mm-hmm. Now, very few people, of course, paid tax at a 70% rate, but that wasn't the law.
Now, that's 70% of their income.
That was 70% of income. Okay. Currently, the rates are down to, in fact, generally a 28%. So, of course, it's not easy to see who's benefited based on those particular changes. So we're likely to see some increase in tax rates.
Very good. We've got a couple of minutes before we end this program. From a practical point of view, persons who might be worried about the filing date of April the 15th, what would you advise?
Well, I think it would be wise, although we may be a little late now, but as the Commission of Internal Revenue Service has stressed, get started early, because there's a lot more information that one has to assemble. And that seems to be not what's happening based on I was just analyzing recently when my clients came in this year versus last year, and it seems that they're running perhaps even 3 weeks to a month behind. So The tax system this year is a lot more complex. You need a lot more data to complete the tax return. So it's wise to not procrastinate, to go ahead and get started.
Dr. Mullen, we've got a minute before we end this segment. Is there anything that you'd like to say from a practical point of view or from a scholarly point of view in reference to practical matters?
Well, the obvious thing that we always say just before April 15th, if you hadn't filed by April the 10th, you need to fill out a form and get a 4-month extension, but you do have to go ahead and pay your taxes at that time. You can't put off paying your taxes, but you can put off filing a tax return, and if you have a complicated tax return and you wait till April the 10th, you might as well forget it. You're going to have to get an extension. Very
good. And let us thank the two of you for coming by and talking about this very practical matter as well as very important matter with us today. And let me invite you to tune in again next week for another informative edition of the Black Pulse of Nashville.